Welcome back to the Commercial Real Estate Investor Podcast, where every week we are interviewing outstanding individuals in the world of commercial real estate. This week, I am selfishly excited to have this conversation. One, it's with Dylan, who's been a good buddy of mine for a few years now in the realm of real estate. But two, he recently raised a $9 million fund, which is something that I've been interested in pursuing for a little while now, because once you have a fund, you can go buy properties. You don't have to raise on an individual basis. So I'm excited to hear how he did that, why they decided to go that route, and how we may be able to do that as well. Dylan is the principal of the Requity Group, which he founded, I want to say, in the last year, give or take.
Yep.
He's been in multifamily for over 6 years. He's been involved in tens of millions of transactions, and as a sponsor or a JV, really excited to see again. Really excited to see you again. We actually had a conversation earlier today. Dylan, what is going on, man? How's Florida doing for you?
I'm excited to be here. It's great that we did a back-to-back podcast show. So it's excited for the next chapter of ours.
Yeah, absolutely. Dude, I didn't realize that you got your CCIM last year. Congrats on that.
Yeah, I appreciate it. Yeah, I was happy about that. I actually started that probably 5 years ago. So it was good to finally bring it full cycle. I had to eventually get up to the experience requirement.
Yeah, that's probably about when I started. I finally took my last class back in March or April. So hopefully going for my designation this fall. But it takes a while. One, you've got of course, you got to get the experience to be able to get the designation. But also, when do you find time to just leave for 4 days in the middle of the week? That's the toughest part for me. It's 8 to 5, during the week. It's a lot of coffee.
Yeah, it definitely is a great networking experience. I was happy to do the program, and I definitely encourage a lot of investors to do it. But like you said, it's easier when you're earlier on, you might have the time, but then once you have the experience, you don't have the time to take the class. So
yeah, that's exactly it. Well, so for everybody that's joining us live, feel free to drop your questions in the live chat as we go along, whether that's about multifamily, raising a fund, commercial real estate in general, it doesn't matter. Dylan and I will be happy to answer those questions for y'all. But Dylan, I gave obviously just a very brief introduction on you and your background, but can you kind of tell us, where you got started in real estate?
Yeah, so I grew up in upstate New York, and I always had the dreams of, at that point, when I was a young kid, going to work on Wall Street and go the whole sort of corporate route. That's what I was exposed to at a young age. And when I went off to school, I had one of those wake-up calls after my sophomore year in college, where I was starting to brainwash myself with personal development and entrepreneurship books, and formed the belief that I was able to create a life on my own terms by using real estate or different, forms of entrepreneurship. As I think many young people eventually they have that sort of moment, or I guess people in general have that moment at various points in their life. But for me, at about 19, it all took a big turn where I said, well, instead of spending my time partying and finishing up school, I'm gonna really go full force into learning everything I can about real estate, sales, entrepreneurship, things along those lines. I bought a one-way ticket to sunny San Diego with the goal of creating this lifestyle by design. Got my foot in the door at a real estate investing and education company. Started off in sales, grew into a sales manager role, saved up all of the commission money I could to go and buy my first single family rental, soon to be a duplex, and started to grow a portfolio investing in turnkey properties, and eventually learned about multifamily syndication. And at that point, there was no looking back. After having a conversation with several investors that had several $100 million in real estate, I really had that light bulb moment where I said, this is a vehicle that I could really see myself, playing a part in for the rest of my life. I had that moment where I really saw this as being a platform that there's going to be enough intellectual stimulation back with enough excitement and enough flexibility to meet a lot of the goals that and I think that fit my personality type to grow in long term, and it's worked out to be that thus far. I thought I would be doing apartments forever, frankly. So I got started in the apartment space, spent about 4 years there, worked on probably 60 or 70 million in total apartment deals through value add multifamily syndications, working with investor capital and doing a couple JVs like you mentioned. And actually, after having a little bit of a dry spell in the apartment space, and also just sort of an epiphany as to the value in mobile home communities, I really made a bit of a pivot at the beginning of last year as my partners and I were starting to go in different directions. I was starting a new company. I said, well, I think there's really something here right now. And I think the next 5 years presents a really unique opportunity for us to get some great risk adjusted returns in the MHC space. So we've been busy with that. Currently, we are up to around 500 lots, and in a few weeks, that'll be closer to 750, 800 total lots under management under the new company. So like you said, we've been off to a great start in this space. We have, the first fund that we launched back in December that we just capped off our first, fundraise, and my first time ever participating in sort of a blind pool fund type of raise or sponsorship rather than a SPV or deal by deal raise. So that's been a beast of its own, but a lot of good learning lessons, and glad to have the first fundraise capped off.
Congrats, man. That's quite a bit of success in just a few years. One thing I want to point out, if you're not very familiar with mobile home communities, that is what MHC stands for. But also, man, multifamily syndication completely changed what I thought my career path was in commercial real estate, because I didn't know that syndication existed when I first found it with Bruce Peterson. Mm-hmm. And man, because I always thought, hey, you've got to go out, you got to make enough money to buy your own deal. Maybe you find one partner that you guys go in on it together. I never realized that you could just go out and raise capital like that. What was your experience going through just multifamily syndications?
Yeah. Well, I think the first time I really was able to see what it was like on the other side, so to speak, it was through a mentor, a guy that is still a near and dear friend to me today, Vinny Chopra, who's done 500 million plus in syndications. Again, hopefully if he hasn't been on this show already, hopefully he'll be on this show soon to share some wisdom with us.
Yeah, we've got to get him on here.
Yeah, definitely. So he was doing multifamily. Now he does some senior living stuff as well. But he was doing, he's at the time when I met him off of a Facebook message, he had done 350 million in syndications, vertically integrated, managed all of his own properties. So he really had worn all the hats of the fundraising side, the investment side, and so on. So when I got the chance to see what his life looked like, and not saying it was all fun and gravy, but I'm saying that it fit my personality type, right? I think you need to know your personality type and what gets you excited. And when I saw that his life was constantly traveling, checking out these different properties, raising boatloads of capital from his investor base, being trusted to do so, and then having the responsibility and duty to go out there and operate these properties well and put out the fires that do take place in the day-to-day management. I just thought it was so exciting, and I thought that was something that I wanted to have a piece of. So that was my first exposure in that sense. And then it took me probably 12 months to go out there and find my first deal. And it was just a small 21 unit deal with a couple partners in a joint venture deal. I felt like, for me, that was a good first deal because I wasn't raising other people's money. It was my own skin in the game. I was getting kind of a taste of what it was like to operate in the space. Then I was fortunate to link up with a few experienced partners, the guys with Rand out of Knoxville, Tennessee, that had an existing portfolio yet had not brought on any investor capital. So that was sort of my value add to the partnership. Was I was this, young and hungry sweat equity partner that was able to go out there and put the systems in place to raise capital, that was able to help handle the asset management portion of things because I had seen what that looked like on larger scale syndications. And they had an existing platform where they had podcast set up. They had in-house management set up, right? So there was some existing infrastructure to build off, which really allowed for us to have a great synergy as partners to be able to start to go out there and do some deals together. And the first deal did as a syndication was 132 units that we're actually in process of selling right now. That should be very successful, full cycle deal for us. That first deal was really a moment you'll never forget, right? I remember even just setting foot on the property, driving, seeing like a true mom and pop ownership group. Everything that I was hoping for in a first deal finally came to fruition after years of studying and hard work. So it was all worth it.
Yeah, it's funny how long it takes you to get that first deal put together, and then the second one comes like that, right?
Yeah.
Because it's almost like you just have to learn the process, and then once you learn the process, man, it gets easier and easier.
Mhm. Yeah, it's completely an exponential growth process, right? And that's why I remember saying to myself, I left a pretty good paying W-2 position and in my early 20s when most people would have been, you know, feeling like they've made it or they're set. I remember leaving this W-2 behind and saying to myself, look, even if it takes me the next 8 years just to break into the space, I saw the potential of what the reward can look like for doing even just one or a few successful deals. So I said, if I can turn this into my life, and if it takes me 5 years of sacrifice to be able to do that, it's still worth it, right? Even if you make very minimal in the transition period.
Yeah, I agree. One question that I get asked all the time: do you think that it was worth it going and working for someone else before going off and doing your own thing, or do you wish that you just dived into investing on your own?
It's hard to say. I think it's very situational as to who you're talking to, but I am a big proponent for going to work for someone else. I think that there's a lot to be said about even just the paradigm shift you have of understanding what it looks like on the other side, right? What does successful operations or asset management look like? Right? What kind of processes are in place? I mean, in 3 short years of working for someone else that is doing what you're seeking to do, I think that that can radically propel your future in the sense of giving you the perspective needed to go out there and do it, right? It's not that far different than the same reason why it took me 4 years to get to the 50 million mark in multifamily, yet we're likely to be back there in a year and a half, doing it again under the new branch in the MH space, right? It's almost like you've seen it, you know what it takes, you know what it looks like, and you're sort of collapsing time frames because you have a better understanding of what goes into that sort of thing.
I think that's so true. I have mostly younger, like 16, 17, 18-year-old kids reaching out to me on Instagram asking, hey, what should I do? How should I get started? How can I save up money to get going in real estate? And the answer is always the same thing. It's just go find somebody that's doing what you want to do and work for them. Because one, you're
Mhm.
getting paid to learn, right? Like look at it that way. Don't look at it as you're getting paid for a job. You're getting paid to learn to do what they're doing. And, how much time, energy, and money are you going to save by learning from somebody else's, learning wisdom from somebody else that's been there, done that, or from
Completely.
their mistakes instead of on your
And you're
own
learning
dime?
on their dime, right?
Yeah.
It's not your own money at risk. You really have nothing at risk, right? You can sleep at night pretty easily if you're hired W-2, right? The guy that's got his money at risk, his investors' money at risk, is going to be the one dealing with the pressure of performing, right? So I think there's a lot to be said about being on that side as well.
Yeah, there's so much about the process too that you don't think about, right? Like I mean, how we're supposed to close on a hotel tomorrow, and the lender, which is a group out of New York, came back with some unbelievable, like I mean, borderline illegal request today that we're just like, look, we cannot agree to that. We cannot have that letter signed in the state of Tennessee. It's just not typically how business is done here. And so, of course, our funding tomorrow got pulled. So
Hmm.
we had to, that's what I've spent all day on today was, okay, well, we're going to push closing to Monday. I've got another lender already lined up. We're going to close on Monday. We're fine. But if I didn't have the experience of knowing like, hey, it's always good to have a backup lender that's set up and ready to
Oh
go
yeah.
because deals fall through all the time within 24 hours. We probably wouldn't even be having this interview right now because I'd
Yeah.
be scrambling to find money and figuring out what the hell I'm going to do with this deal. But I'm
Yeah.
not stressed about it at all because you know what to do.
No, I think that's really important, for everyone to hear. I mean, that is a typical day in the life. There's probably one day a week where you have a crazy fire that you're putting out, and that's all you can deal with the whole
Yeah,
day. So that's the craziness that this brings along with it. But I would say that to your point, especially if I'm talking to someone that's younger that has less life experience, but really anyone at any age, I'd say just take the ego out of the picture, right? I hate this whole I want to be my own boss movement, to where there is almost a
Right.
giant segment of the population that has ego getting in the way of them being willing to take orders or go learn from someone, right? When I was getting in, I was trying to think, how can I work for free for someone and just put it all on the line just to get around people that have success. I was willing to do anything, for free, to just simply get around the space and start to, absorb, what it looked like, how to underwrite, how to manage your deals, be around the property management side, right? So I was finding ways to add value. And I think that the sense of, you really need to get rid of any sense of entitlement to how much you should get paid in your first year, how much equity stake you want on your first deal, how much, all of it, right? So I think that taking all of that and just the more you can program yourself for delayed gratification, I think you're going to wind up being radically more successful down the road, because those decisions don't stop, right? I'm sure Tyler is in the same spot I am right now, where I'm saying, rather than saying how much should I pay myself, I'm saying how many employees should I hire to make sure we're scaling an effective operation, not dropping the ball on anything, right? I'm
That's
still
exactly
making
right.
delayed gratification decisions every day, trying to push my own prize down the road. And instead of paying myself, I'm trying to build our team, trying to scale, trying to give better performance to our investors, right? So you have to start getting in the habit of that early, because there's the whole leaders eat last philosophy, right? Of, you're going to be the last one to get paid if you really want to be the top dog one day. So I think just, understanding that early on is helpful.
Yeah, you really do need to learn that. It's one of the best. Patience is a virtue, but it really is one of the best things that we've done. I mean, I could be taking my payday every month, every quarter, every year, but I don't do that because we're building something bigger than that. And that's what I'm focused on. You're right. Like, we've gone this time last year, I had 3 employees. We've got 13 now. So all that I'm doing with all the money that we're making is just hiring a team to build it better next time. Because we've become that much more efficient. One quote that came to mind, this is one of my favorite quotes of all time when you were talking about, you got to get in and learn, is from Miles Davis. You got to learn the rules before you can break them. You can't just go out there and break the rules if you don't even know what they are, right? And I think that's really important to sit there and ponder, because I mean that's why we're both proponents of going and working for somebody else. You got to figure out what they're doing to figure out if you want to do that or do it differently or do it better or improve upon it.
Mm-hmm. Big time.
Yeah. So let's dive into this fund thing, man. Can you explain what a fund is? What is a real estate investment fund?
Yeah. Well, first off, anyone listening, don't do it right away. That's
Yeah.
usually the first
Don't
thing
dive
that
into this.
everyone listening, and probably that tuned in based on the title, saying, "Oh, I want to just do a fund, right? Why raise on a deal?" So that I need to start there. But what a fund is a fund is effectively a collective pool of investor capital that invests into numerous deals, more often than not, that are not closed on, or in many cases not even identified prior to the funds being committed, so to speak, right? This is speaking broadly, but that's the fund that we're talking about today, right? This is a 506. The exemption from the SEC is the 506C fund, which means that you can publicly advertise, but you can only bring in accredited investors, and accredited investors will then commit capital to the fund. And the way that our fund is structured, in which I probably would encourage most funds to be structured, is a way in which when someone makes a initial commitment to your fund, they're not investing their entire dollar amount into a bank account, right? They're usually putting a very small deposit down. And then as you are closing on deals and you need capital, you effectively draw down on that commitment. So you're pulling down capital over a period of time, anywhere maybe between 12 to 24. I've seen them up to 36 months, right? So you're incrementally drawing down on their capital until their entire capital commitment is put to work. So in our case, we're targeting MHC, manufactured home communities, and we are targeting to do roughly 6 to 7 deals, right? So over 6 to 7 capital calls, the entire commitment amount will be drawn down and put to work. The reason we're drawing it down is because generally you are focused on good returns and you have a cash drag when you have money sitting in a bank account. Generally, you're going to have some sort of a preferred return in place, which means that you're accumulating a preferred return with no physical asset to back that preferred return, which is just meaning you as the operator are starting well behind the 8 ball and you're not going to have the cash flows to be able to distribute. So that's generally how a fund works, where you have a period of time that you open for commitments, say anywhere between 6 to 18 months is a general average window that you might be raising for a fund. And then around month 6, you may start your acquisition period where you're going to start looking for deals. If you don't already have them identified, start closing on deals, and you may be purchasing deals between month 6 and month 36. We'll say, right, those first three years of a fund generally are drawing down the capital, putting it to work, and then the fund itself may last for, I know in our case, it's a 10-year fund, right? And I think that's a pretty standard number of years. So you have a period of time where you're deploying the capital the first 3 years, then you're improving all of your projects the next 2-3 years, and you're holding on to them, and maybe you're doing a capital event somewhere along the way where you do a big refinance event, pull back some initial capital, and then eventually you generally will go on to sell them unless you have a unique fund that's an evergreen or something like that.
Cool. We're going to have a lot to unpack with that. I'm really excited. Okay. Why did you decide to do a 506C instead of a 506B? If you're not familiar with syndications, those are really the two different types of, well, I guess syndications and funds that you can do according to the SEC. 506C may be marketed, but you can only have accredited investors. And then 506B is a friends and family raise. So that is anybody, you can have up to 35 unaccredited investors. So why did you go with a 506C versus a 506B?
When you're doing a fund, you're generally raising for not just a one-off moment in time, right? When I've done my last deal, right? The last deal we raised $2.5 million, and we had full commitments within 24 hours of the full launch. So I knew that before the full launch, I was going to market this to all of my existing connections, those that are accredited and non-accredited. And generally on a 506B raise, I might pull 25 or 30% of the entire raise from non-accredited investors. So I've had a fair amount actually be from non-accredited. So this isn't about saying, oh, the non-accredited people don't have a lot of capital. They've actually made a pretty significant dent in my previous ventures and raises in my investor base. But with the 506C, this is more beneficial for a fund because I'm going to be raising, in this case, I raised for 7 months roughly, right? So it was open for, period of 6 or 7 months where I have to be sending out emails. I have to be occasionally, I didn't do that much on social media, but occasionally making a post about the fund or what's going on there. So it just really opens me up to a lot more liability where there's so many instances where it could look like, oh, well, he's selling and promoting these securities to non-accredited investors and and they're not pre-existing relationships, right? So I just think that with the fund, I think it's safer. It's a much safer bet to play it completely above board because you're going to be raising for months at a time to have it be exclusively for accredited investors, because you might have some referrals, right? 3 months in, someone says, hey, I love what the fund's doing. I got some friends that want to invest as well. And now you're able to accept their capital because they're accredited and there's no pre-existing requirement.
Yeah, that makes sense. So when you're going through the drawdown phase, right? Because obviously you don't want all that capital just sitting in your bank account, burning a hole in your pocket and accumulating interest. When you're going through the drawdown phase, is it common for some investors to say, hey, I want my full $100,000 committed right now? Or do you take a pro rata share from everybody based on the project? How does that drawdown work?
Admittedly, that's the most challenging piece, or that's the one piece that I sometimes dislike about a fund, is that for some investors, it seems frustrating. They're saying, hey, I want to put all my money to work and you're not letting me, right? That is a conversation that I've had to have with a couple investors, right? They make a commitment, and I have to set the expectations that this is going to be drawn down incrementally. Here's why we do it. And generally, if you explain it well, they usually respect and can appreciate the fact that you're not putting too much cash drag on the fund, and it's going to be in their best interest. But you have to, explain that well. The issue is the way that you typically draw down is based on a percentage, right? So right now we're about to go into our hopefully second to last total capital call period. So we're drawing down and getting everyone to roughly a 70% of their total committed capital will be invested and put to work. So the only downside of that is that some of the investors are already at 65%, right? So a lot of this means that it's the investors that jumped in last minute that have none of their money put to work that are going to be putting in 70% of their money in one swing. And then a lot of the investors that were in on the last call, then they're going from 60 or 65 up to 70. Right. So I'm telling them, hey, if you want to go and put all of your money in right now and just keep it on the sidelines, we'll keep it on the sidelines. We'll watch over it and do the accounting for you, but it won't be accruing a return. Right. So I'm trying to at least make it as convenient as possible. But that is generally how it works, is that you generally want to keep everyone at the same percentage of invested capital as you go through and draw it down.
Yeah, I mean, that seems the most fair and equitable way of doing that, because you can't be telling some guys, yeah, we'll take 100% of your funds now. These guys can keep waiting, and you would have some very unhappy investors for sure, I would imagine. Mm-hmm. What are the typical like minimums, maximums that you would have on a fund? Do you have maximums?
We don't have a formal maximum. I think we said the maximum was 20%, or $2 million roughly. So I think we said that because that would mean they'd have to sign on the loans, right? Yeah. So if someone wanted to do more than that, then we would discuss that and make sure they're okay signing on the loans. But we do have a minimum. The minimum is 100,000 in this case, and we've been pretty strict to that. As I think when you're raising $9 million, anything less than 100 doesn't move the needle all that much. One thing that we did in this case was we tiered the commitment amounts to unique classes of shares to incentivize larger checks. So we did $100,000 equals an 8 pref with a 70-30 split above the 8 pref, and then for $300,000 we did an 8 pref with the 75-25 above the 8 pref. So that really gives everyone an opportunity, if they're willing to stretch a little bit and go up to the 300 mark, they get an opportunity to have a bit better returns than they do in the Class A shares that we had in place. So what I found with this, which is really interesting, is not just do you have some larger initial commitments, but you have a lot of people that sit there at the 100,000 mark, and then they watch you, and then 6 months later they say, hey, we really like what you're doing. We really believe in what you're doing. We want to get the $300,000 mark. So they'll increase their commitment to $200,000 before you're done fundraising. And now you have a lot of these increased commitments over time that sort of snowball, which really move the needle quite a bit for us.
That's really neat. I've heard of sponsors setting up structures like that in order to incentivize higher investments from the investors. And so let's dive into that a little bit more. I mean, how do you go about underwriting that? How do you really structure that in the deal? Because I would imagine that you have to have that put together in the docs ahead of time of like, hey, does that create a Class A, Class B, and a Class C share? Mm-hmm. How's that work?
The way that we have it structured, we just have it as a Class A and Class B. They have two options, but there's numerous ways to cut in. Every attorney structures things differently. But in this case, yes, I had it all formally outlined in the documents that this is what that structure looks like. And I even did something with our investors from their first deal. We did an SPV. When I say that, I mean special purpose vehicle or deal by deal raise. We did an SPV in our first deal, and just to really reward the people that believed in us the most on that very first deal we did, we said we'd even count their commitment towards that deal towards their total of 300, right? So we specified all of that. So if they had a total of 300 with us on that first deal and collectively with their fund investment, we would reward them for that, for being, the early adopters, so to speak, for our first fund. So I think that went across well. And you do have discretion on that as a sponsor. If you hit a point where if someone's at 250, you have some sort of agreement, like there is discretion there where you can have some level of flexibility. But you want to be careful on, how frequently you use that discretion, I think.
Do you just have a like an underwriting spreadsheet that has waterfall tiers as to how that gets handled?
Yeah, that's the second part. Yep. The way that I do it personally is I just show everyone what the lower of the two looks like. I simply just show any of my projections. I'm just showing the 70-30. I'm not showing what the IRR looks like or the cash flows look like for the 75-25 shares. It's just because it's going to vary so much. If we outperform our expectations, then it's going to outperform it by more. And it's not even worth. I try to keep things simple. I'm a big proponent to trying to keep your projections and your investor stuff as simple as possible, with simple structures, simple explanations, and I think everyone knows, inherently that you're not going to perform exactly to your IRR, right? Hopefully, we do better than it, but so I think that they get the fact that, okay, they're going to get a better deal. They're going to beat whatever that target is if we hit exactly on par with our expectations.
Yeah, that's really interesting. So we've talked about a lot of the pros of a fund, but there are definitely cons as well. So can you talk about the bumpers, basically, that get put on you when you raise a fund like this?
Yeah, so we hit on the first one, which is just sometimes a misalignment of interest if investors want to put all of their money to work. And I'm saying, hey, look, you have to, you have to spread it out over numerous deals. And, again, that's trying to flip it and see the opposite side of the coin, is that you're going to be more diversified than you are in one deal. But that is sometimes a challenge, at least it's in my head, that exists. And then outside of that, when you do a fund, you have usually a very specific set of parameters that you set for yourself. You should be setting for yourself, of like, hey, we're going to be buying manufactured housing communities in the Southeast exclusively. Every single deal is going to have some MHC component to it. It can have some RVs, some apartments, something like that, but it has to have an MHC component to it. It also, generally, we're targeting 6 to 7 deals throughout the life of the fund. So we're generally looking for deals that have, maximum of $2 million roughly in equity committed to each specific deal. So if we have a deal raised bigger than that, we're going to have to set up an alternative vehicle to fund the remainder. We also generally have a timeline where we expect to deploy the capital. That said, I don't want to put too much weight on that, because you don't want to go and buy a deal for the sake of buying a deal. So
Right.
the timeline is loose, and you want to keep that long. But generally, you are at the mercy of the parameters that you set for yourself. So when you're structuring it up front, you need to really be disciplined and know that you're going to be disciplined to what you're setting for yourself. And if the market takes a turn and you're having trouble being able to find something to meet the mold, you're just going to have to be able to set those expectations with investors that, hey, I know you've made this commitment, but right now things just aren't looking as good for acquisition opportunities. So we're doing the right thing by not buying anything right now, right? So I know that because back in multifamily, I remember talking about doing a fund at a point where I was later very glad that I didn't do it, because I had such a dry spell when it came to finding something that I got really excited about. So if we had a fund, we would have just been even more painful, I believe, as sponsors during that period. So, right now is a unique time where we think that we have ample deal flow with the MHE space. But, I think if you want to remain as nimble and flexible as possible, then deal by deal can oftentimes be the way to do so.
Yeah, that makes sense. You don't want to just go out and buy deals for the sake of buying deals. I've seen firms do that. A lot of hedge funds will get into that issue because they raise all of this capital, and then all of a sudden they've got $1.5 billion they have to deploy. And you start thinking about what you're really going to have to buy in order to go deploy that. I mean, it's, there's certainly pros and cons. When you put together a fund like this that is specifically for mobile home or manufactured home communities, it's funny. I mean, you almost want to keep it like narrow enough so that the investors get on board with what your vision is, but general enough, broad enough so that you don't have too narrow of a lane to where you can't find deals. Does it preclude you as the fund manager from going out and buying a mobile home community without the fund?
It does not. No, there's generally, have I done that? No. I made the commitment to myself and to our investors that I'm not going to go and buy a deal on my side and try to make myself wealthier, while I have this commitment to these fund investors, right? So I said that any deal I touch that would meet the mold of the fund, the first 1.5 million of that deal equity wise is going directly to the fund. Anything above that, we have discretion if we want to bring an SPV on or do any additional investment, something like that. So that was sort of a personal choice that I made, but generally it does not restrict you in that sense, and it doesn't handcuff you if we found a really attractive apartment deal that didn't meet the fund's mold, but we could go raise money and do an apartment deal that we have total flexibility there, and I don't think that would be much of an issue. But it's more of you can set the documents to read however you'd like them to, but you have to sort of think deeply about your own moral compass and like what is the right thing. Because I think when you do a fund, you really have to be putting the fund first for the time that you're in the value creation stage.
No, of course. I mean, if you ever want to go out and raise capital from those investors again, you're going to have to prove to them that you're constantly looking out for their best interests, right?
Exactly.
So now that you have completed your first fund, I mean, looking back, like let's kind of do an autopsy. What would you have done differently? What did you learn that you did not expect?
Yeah. So I of course, naturally, I tend to do a lot of introspection and try to think about these things often so I can do it better next go around. Number one, I would have not bought deals as early on as I did. I would have done more of the fundraise before closing on deals, right? You should give yourself a 6-month window and say, all I'm doing is fundraising. And I want to have 75-80% of my fund committed before our first close. And then it'll make that second round of raising very easy. You'll finish the fund and you'll be done, right? My fund, fortunately, the deals we bought, we did well on. So it made the selling later on down the road easier to say, hey, look, we have proof. We have 6-month operating history. We're doing well on these deals. So you guys can see it and you're already getting into a more proven vehicle. But imagine if those deals didn't go well, right? Obviously never our intention, but if they didn't, then the early investors that took more risk going into the more blind pool fund are now at a disadvantage because you're not going to hit that number that you were hoping to hit. They're not going to get the diversification that you promised them, and your whole world can crumble. So not to be too dramatic, but it could get very ugly. So I wouldn't buy deals right away with the fund. I would try to raise the bulk of the money before I go out and buy deals. That's number one. Number two is I would have some sort of an incentive structure to not only incentivize higher dollar amounts, but to incentivize earlier dollar amounts, right? One structure that I've seen other fund operators do, they're raising tens of millions frequently, are they offer for the first 5 million that comes in, right? Say we do a $20 million fund, which is probably what we'll target, in the one that we launch next year. Say that the first 5 million, right? Maybe they get a 10% discount on the 30% promote that they're paying, right? So instead of paying 30%, they pay 27%, right? Then on the next 5 million, and they're, instead of paying 27%, they're paying 28.5%. But you can't call it a penalty, right? You got to call it a reward, right? It can't be like, oh, our later investors get penalized. It's our earlier investors get rewarded.
It's just an incentive for the early ones, yeah.
Exactly. So we offer this incentive structure to reward our early investors, and that's going to get the needle moving faster because they're going to say, I don't want to miss out on that first 5 million window. So let me make a commitment early on because I believe in these guys. I see where they're going. So I'm not going to drag my feet for 4 months to see what kind of deals they have in the works because I want to get the better promote than the later guys are going to get. So those are the two big ones for me is a discount to reward people for moving quickly and early. And also, when you're going to start the acquisition period.
That's interesting. I never thought about incentivizing investors for coming in even sooner, but I love that. That's something that we're going to have to throw into our repertoire and really think about.
Mhm.
When you were setting up your team to put this fund together, I would imagine you didn't have the legal background in setting up funds or anything like that. I mean, going into this process, you've said, I want to start a fund. Who did you surround yourself with and what were they doing?
Yeah. So to a degree, again, I'm very happy with how things have played out in the last year, and I think we've been very fortunate that things have been moving in our favor, and we've been working our butts off to make sure that they do. But to a degree, when it was getting started, we had done the first SPV. We were early as a company to say, hey, let's do a fund, but we felt like we had really good deal flow, and we had deals of different shapes and sizes that really did present sort of a perfect storm of to give us a chance to get this diversification and different risk profiles all into one package. So we said, look, let's do a fund, but not only let's do a fund, but let's try to do this as professionally as we can to set the precedent to investors that like we have third party oversight. We're doing this the right way. We plan to keep doing it the right way and make it sort of institutional looking and feeling as possible of an experience, right? So we brought in an attorney named Simon Reveles of Reveles Wahab out of New York. He drafted our docs. You can certainly look him up and find him. Riveles. He's done a ton of different private equity and hedge fund documents of all different sorts, and he put together a very professional set of docs for us out of the gates, and had a lot of unique insight when it comes to how we're going to structure things and things along those lines. We had an outside member that we actually ended up giving a small stake to of the fund to serve as a mentor with us as well. He had ran hedge funds in the past and has been around this world quite a bit. So bringing him on as sort of a mentor / advisor with vested interest with money in the fund and also his own skin in the game on the general partner side was also helpful to get sort of an advisory board set up in a sense to as we kind of hash through all the legal docs together. Then we went on to go and get a third-party fund administrator, which is basically a third-party group that does all of your capital call. They do all the complex calculations of how to do your distributions, how to do your return of capital, return on capital. They'll send out capital statements to the investors. So we have a third-party administrator that handles they'll make sure all the docs look good. They'll make sure the investors send in all of their accreditation docs, their IDs and W-9s. So they handle all of that administrative side of things, and having a third party with a group that's managed billions of dollars of capital and is compliant to the absolute T, at sometimes can add some friction because again, because of how compliant they are, they're trying to make sure every dollar that comes out of one investor's account is coming out of the right account attached to their name, and they're not breaking any anti-money laundering laws, things like that. So we got a third-party administration group. We use a group called NAV. And then we also went and we found an auditor that for a $10 million fund, is at a reasonable price point where it didn't really have a drag on the overall returns. So we have third-party administrator, we have an auditor. So we're really getting the full experience in place with a lot of outside oversight. But I think that for investors that's meaningful because a lot of the alternatives or a lot of I think the deals that they probably see from various indicators are that there can be things where they don't trust it, the documents haven't been reviewed, they're not really so certain as they're just forming a brand new relationship with someone. So if you're going to go invest with a complete stranger, it just gives you that little bit of extra peace of mind. I think that there's real systems in place here and oversight. So
Yeah, you got to have that. I mean, that's one thing that I tell everybody is like, look, we're governed by the SEC. That's about as big boy as it gets. And you don't want to mess around with that because, the SEC comes in and audits you. You could lose. I mean, if they find you doing anything wrong, you can lose the ability to ever raise capital for anything ever again, which I don't know about you, but that's what I do for a living. I don't really want to lose that privilege.
I remember I actually spoke to a guy that manages a fund, and he said that the one time the SEC knocked on his doorstep, and it was something that they had no idea they were even doing wrong, and it wasn't anything that was obvious to them. but they weren't getting audited at the time. He said it was an $800,000 learning lesson. So that's not money to joke about, right? So I said, well, that's extremely valuable information, right? So let's do it by the books. Let's get audited, right? Let's do everything we can to keep things above board.
Yeah, that's smart. Speaking of other like syndications and stuff like that, do investors in a fund get the same tax benefits as other real estate investors?
They do. We're in one of the most tax advantaged forms of real estate investing in this asset class. So we have investors that exclusively invest in the fund for the depreciation benefits. So the diversification doesn't make a huge difference, frankly. I mean, I guess you're getting a blended average of number of deals rather than just one deal in itself. But absolutely, we actually made the conscious decision as a sponsor is we would not take any of the depreciation outside of the money that's we've invested personally. We're not going to take any depreciation, so that we can really reward the early investors again. So I think that was another thing that helped early on raise capital in the first one.
Interesting. Have you done that before on other projects?
Never before. I've taken roughly 30% as a general partner because we're real estate professionals by the tax code, so we benefit tremendously from that depreciation. But I had a lot of depreciation from previous deals going into this, so I didn't really need it, and it was a great way to reward and further incentivize the investors.
That makes sense. I love that. That's actually getting pretty creative there. We've talked about a lot of creative strategies for putting together a fund or a syndication or how to structure things with your investors in this episode. That's pretty cool. What do you think about crowdfunding? I mean, have you ever considered doing that to fund one of your deals?
Crowdfunding in the sense of using one of the online platforms?
Yeah.
I have not. I explored it many years ago when I was still too early to be approved for traditional crowdfunding, right? I didn't have the number of asset requirement when I initially explored it 3 or 4 years ago. So it's something that I put on the back burner at that point, and I really haven't revisited it. For me, my general take is that bringing together the capital is not that much of an issue right now at this point in time for us. And at least on the deal sizes we're doing, we should be able to bring together most of the capital we need. And I'm similar to you. I'm trying to continue to play the vertically integrated card as much as possible. So I really like the idea of having like true outstanding relationships with the investors that I'm with. And it's not just like this complete transactional thing where there's a website blocking us from getting to know each other. I like the idea of, working and finding ways to reach out to new investors, build relationships with them. And, I have plenty of investors on a complete like texting basis now where we're constantly texting about deals and things we're doing. And that's really, I think it just makes it more rewarding in a sense.
Absolutely. Well, Dylan, this was a great talk on funds. Appreciate you coming on the show, man, and sharing your knowledge. Look, I personally learned a lot. I'm sure the audience did as well. If anybody wants to get in touch with you, whether that's to invest in your next fund, you said you're raising $20 million next year, or they just want to learn more about mobile home communities or whatever, how can they find you?
So you can visit therequitygroup.com. That's the REQUITY group.com. Certainly, you can plug in there, and if you want to fill out the form, we'll add you to our distribution list. Generally, we like to set up a call first, and we'll add you to our distribution list so you can see offerings, but also you can just see general updates that we like to send every month or so. We'll send out just general updates on what we're thinking, where the market's going, things along those lines. So we always like to kind of keep people informed and make it a priority to educate. We'll be launching a podcast here, hopefully in the next 30 days or so. So that'll be called Operators and Allocators. You'll have the man himself going out in just a couple of months here. And you can visit. I'm really not super active on LinkedIn or on social media outside of LinkedIn at this moment. So generally, if you want to catch me on social media, just plug in on LinkedIn or shoot me an email at dylan@therequitygroup.com.
Awesome. Dylan, thanks again, man.
Thanks so much. My pleasure.